Good morning, everyone. Delightful to see so many of you here this morning. It's my pleasure to compare this session on distressed investing or distressing investments. I'm Malcolm Frodsham. I'm the research director at IPD. But what I do have is a very august panel to discuss this topic. So I have got Raymond Jacobs, who is the Managing Director of Franklin Templeton Real Estate Advisors, where he's been since 1989. And he's head of the European Property Investment and Portfolio Management and sits on their Global Investment Committee. They've got £650 billion worth of assets under management globally. We then have, it's a size thing, yes. We then have Dr. Mahdi Mokrane, who's Head of Research and Strategy for AEW Europe in France, where he's been since 2004. He has published widely on investments, underwriting, strategic fund analysis and portfolio construction, and he sits on their Global Securities Allocation Committee. He's also an Associate Professor at the University of, I can't read my writing, Sergi? Used to be, oh no. You're on leave. We then have Emmanuel Verhoosel, who's head of real estate funds in Europe and USA and structured products at ING Real Estate, where he's been since 2008. So he's head of the Americas, Europe, and structured products. We then have Dennis Watson, who's managing director of specialist debt finance at Barclays Corporate, where he's been since 1986. He informs me that his portfolio is worth 25 billion. So overall, we've got about 100 billion of real estate under management on our panel. So what I'm going to do first, I'm just going to set the scene with some numbers on the direct real estate market taken from the IPD indices. So here we go. Lovely. So just to let you know who IPD are, we are the global leaders in real estate performance analysis and risk services. We cover about 24 real estate markets across the globe. We're established in 1985. Now you probably know IPD best for its real estate indices, but I always think IPD is a little bit like an iceberg. The bit you can see is actually the small bit, that's the public bit. There's a huge amount that's actually going on privately. So most of our clients, it's a very private service. It's all about portfolio analysis, measurement, and benchmarking. And here's a list of our clients. So we've got 9 of the 10 largest real estate managers and listed property companies are our clients. And this is the source of the information I'm going to show you. So we've taken this information from direct real estate portfolios across the world. Now, not all of our results are in, so just to put all these results in a long-term context, some of our indexes go back further than others. So in 2010, we're covering 23 countries, 52,000 assets, about 750 billion euros. So some of these histories are longer, so 12 we got back for 15 years or more, 8 we got back for 20 years or more. But really what's quite nice, just putting the real estate market in a very long-term and global perspective, is you can see these cyclical downturns that we've been through in the past. So we're in a stage in the market, we've been here before, and we know what happened. We knew what happened in the 1970s, problems in the secondary banks. We've been here in the early 90s. Here we are again. It's a recurring theme. Here's our results for the 9 countries where we've got numbers in so far for 2010. Ireland there, relatively good year compared to their performance over the last couple of years with a total investor return. So they're actually total investor returns there of minus 2.4. All the way up the rankings. And then we've got the markets that have recovered very, very strongly in 2010. So the UK there with a 15.2% return, the US with a 15.1% return. So when we compare those numbers to 2009, you can see that recovery. In fact, the UK there has already started recovering through 2009, and actually it's Ireland and the US that have come back most strongly. So we've got a very particular focused areas of the real estate market globally that have seen areas of distress in their direct property markets through 2008, and we've now already come through that stage and moved into this remarkable recovery. Now, I thought I'd show you that just focusing on our UK data. What I'm showing you here is not just the total return to investors, so that's the income plus the capital, but I've also got two lines on there showing you the drivers of the capital values. Now, the gold line there, that's showing you the rental values in the UK. Now, you're probably looking at that going, well, you can barely see that cycle. And that's really the point. You know, we've been through the last 10 years. It's been a remarkable yield-driven cycle, an investment-driven cycle. So all the boom and all the bust was driven by investment. And so now we're into this aftermath. We're into the recovery phase, which we're here to talk about today. Now, clearly, looking at the market averages sort of denies a huge amount of detail underneath. And one of the big issues in today's market is it's very, very polarized. So we've seen a very, very strong recovery in very, very good quality assets across many, many markets. There are many areas of the market that have not seen such a strong recovery. So what I've done here is just to get at that story, I've divided the assets up into the UK, into the lower yielding assets and the higher yielding assets. So if you think the yield is basically a function of the covenant strength, the length of the lease, the quality of the asset, and the quality of the location, and those assets which score very highly on all those points are shown there in the blue in each of their segments, you can see that their performance is very, very strong across the board. Now, before I draw your attention to the weak parts of the market, just look at the strong part of the market there, the central London offices. You know, it's no surprise we've been through a huge financial crisis. We've seen an unprecedented response from the regulators and the international governments. And the benefit there you can see in those markets which are most dominated by financial and business services. So central London offices have benefited very strongly, as have Paris. And you can see in those markets, generally all of the assets are performing very well. And indeed, it's actually the poorer quality assets that are now performing strongly. So any of those assets that are in any of distressed loan portfolios, there isn't going to be an issue. But let's look at the weaker parts of the market. So these are the more regional parts of the market. These are the markets more dominated by local consumer spending and also dominated in many of these markets by the government sector. Here you can see much weaker performance in the poorer quality stock. And it's how much of this stock is actually remaining in the CMBS structures, in the bank portfolios, that the attention is now being drawn to. So distress might not yet be quite behind us. And just to finish off, really, just to show the longer-term perspective, I'm just showing the very longest series we could put together in the UK. And what it really shows is these regular booms and busts that we've seen over time, and how it's against a backlog of this long-term decline in real capital values, which is basically what you're going to get on real estate. It's very much an asset class dominated by income. But of course, when you're below trend, it's the perfect opportunity to get into that market. And I know we've got 3 investors here that are very keen to get into that market. And we've got one banker that might be keen to make sure he keeps as much value as possible for the bank. So we'll move on to the discussion session. So I understand I don't touch that. Now I'm going to do it slightly differently. Normally there's questions at the end for 15 minutes. But what I'm going to do, if anyone's got any question at any point, give us a few minutes just to get warmed up. I'll basically take your questions at any point as we go through. But obviously give everyone just a little chance to set the scene. So we've had lots of talk, we've had lots of hype, lots of money been raised for these to take these distressed assets. And it's all proved to be rather underwhelming, shall we say. Now, obviously there's been a large government stimulus package, a lot of bank bailouts which have encouraged this sort of pretend and extend expression. So, I wonder if, Dennis, you'd like to start us off and just discuss whether you do think this sort of pretend and extend approach has been encouraged and where we're going to see this moving forward.
Sure, thank you, Malcolm. I think the concept of extend and pretend, it's a very interesting soundbite. You know, it's very snappy, it's very punchy, and it has an element of truth in it, so it makes it very, very interesting soundbite. But we need to be very clear that when we talk about distressed assets or distressed loans, it covers a very, very broad spectrum. And so if we take ourselves back to 2008, in what was unprecedented times, banks were sitting on positions that were very, very big distressed positions. But as you point out quite rightly here, we've seen quite a rebound in valuation come back very, very quickly in some of those markets, in some of those segments. And so what was distressed during 2008, 2009, at a lower level of distress, is no longer distressed. So do I agree that there has been an element of extend and pretend in the banking market? Absolutely. In the CMBS market, we've seen it too. But do I think it's as widespread as some people would perceive? Probably not.
And do you think we really know the extent of loans that are sort of underwater in the market today? Do you think there's enough transparency into bank loan books as to actually how much distress actually remains there? Or is it really in a bit of a fog?
I'd like to think most of the banks know exactly where their position is. If I speak about Barclays, and my remit is Barclays in the UK, of that 25 billion, we have a proportion in real estate. Back in October 2008, we could see that the position was deteriorating. We thought, how do we get to that best? And we put in place a property workout team, which was ostensibly 20 professionals, focused very much on what we perceived to be the loans that were becoming distressed or were already distressed. And our expectation at that point in time was that this would be a 3 to 5 year workout program. And the thing that has pleasantly surprised us, largely, or certainly in part driven by that rebound in values, is that what was distressed is no longer distressed. For our own part, we had a smaller portfolio than a number of our competitors. We weren't as heavily leveraged in those transactions either. And so we found that we worked through that situation much more quickly, and we actually disbanded the team in Q4 of last year because there wasn't the critical mass to keep them going. Now, clearly, in that respect, we're in a far better position than some of our peers who are still working through much, much bigger portfolios with much greater leverage on as well. So do I think each of the banks understand where they are? I think by now they should do, for sure. As a market, is there the level of transparency? I think people are getting to grips with what the banks are adopting as policies and as strategies to deal with that book. So I think there's more transparency. Is there as much transparency as some people like? Probably not.
Emmanuel, I mean, we're talking here about banks that have been able to keep distress on their balance sheet, but clearly that's not the case for all banks. It's not been the position everywhere. So do you think really that it has been a lot of hype, or do you actually think there has been some sort of action, if you like, going on?
Well, I think
I think it'll be on, I think. Yeah.
It's on? Okay, sorry for that. I think we have to distinguish about the lenders, the type of lenders which had loans on their books. Some lenders had loans on the books which were due to distribution to CMBS or to other type of instruments, and they've been stuck with this position in the downturn. And these, which are mainly the investment bank, sold or are in the process of selling the remaining of the portfolio at discount. And there, the issue is not so much that these portfolio are distressed in relation to the underlying real estate, is that these two costs, the cost of the capital is too high on a mark-to-market basis for this bank to keep the loans in the books. So they want to have clean books. And there you see sell at discount, But it's not always because the underlying is in distress. It's just that this position do not fit the strategy of the bank. And there you see opportunities. For the commercial bank or the universal bank, indeed you have a difference between banks which had government help and the one who had not. The one who had government assistance, mostly they got time to work out the portfolio, and there was an active decision by both the bank and the respective government to say, well, we have a choice. Either you transfer your loan to a bad bank or you sell your portfolio immediately. Selling a portfolio immediately which was under distress would have collapsed not only the loan market but the underlying real estate market. So basically nothing happened. And that was an intentional decision, political decision, not to take place. Now, from a bank perspective, there's also a positive side of it. It's like highlighted by Dennis. Banks also have their commercial ambition, and they're looking at, well, where do I get better off? Keeping a distressed loan in my book is quite expensive because a lot of capital has to be allocated to that, or sell at discount. And what banks have done for 2 years, they had the time to create workout teams, work out this loan, and by chance or by good view, indeed, the value of the estate went up, and some of this distressed portfolio is not distressed. However, part is still distressed. And there's a lot of capital allocated to that. And Basel III, which determines the capital to be allocated to real estate loan, will not help. And this bank, at one point in time, will have to dispose of these assets because it's too expensive for them to hold these assets. So there's an opportunity.
So Raymond, over the last couple of years, have you been able to profit from this market, trade on this distress? Has it been an underwhelming market for you or an overwhelming market?
Well, it has really been an underwhelming, as you mentioned at the start, for us. In terms of the debt opportunities, we work in the value-added opportunistic space of the market. So when the decline came and we saw markets coming down, we looked, where is the opportunity coming from? Is it coming from equity investments or is it coming from debt investments? At that point in time, we believed strongly it would come from debt investments, being able to pick up the distressed loans from the banks, work them, or either foreclose on the loans and take in the assets. Either way would have worked for us. As we just heard, very little was actually sold by the banks. And I think we heard the reasons why. I would like to add one other factor, which is probably a very important one, which is we talk about the banks, but behind the banks are obviously people. So it turns out it's always a people business. And a lot of these people, specifically in the banks that had severe problems, they were no longer there. And that was part of, I think, of the problem in terms of making this a smoother process and maybe a faster process of letting some of these loans go, because the people that were had originated those loans were no longer there to to work with the equity owners or other parties to offload these loans on the book. So we've really moved away from from that opportunity set. There certainly will be some opportunities, and there are some debt funds in the market currently that are looking for opportunities. Certainly on the core side, where the prime type assets were in the early stage, and we're going back, say, to the middle of 2009. There were still opportunities to provide mezzanine loans for recapitalization of these type of prime assets. That has gone because the market has built out these prime assets, and there is really very little distress to be found in those. There's plenty of equity capital, specifically from sovereign funds, that is looking for those type of assets, and prices are, in some cases, even higher than they were before the crisis level. So we are really looking at the equity side of the spectrum to find those partners, since we are a manager of managers, so we're not investing ourselves in real estate. We're looking for partners around the world that will help us find these investments. So we're looking for partners that actually can access these distressed opportunities, which will come from either distressed owners that need to recapitalize and from banks that are looking for a solution for those loans or those assets that they have taken in.
So Mahdi, we've heard underwhelming situation, potentially not a huge amount ahead. So are these distressing times, or should we look now to equity?
No, just a quick word of introduction. What we do is we manage assets directly, essentially through either separate account mandates, i.e. Managing the real estate exposure of institutional investors, or and in managing funds in different strategies, core, value added, and opportunity. And I have to say that the implications of this theme, distress, over the past 2.5 years and looking forward over the next part of the cycle, I think the first question is how will that affect the direct markets first? That's our key thing. Namely, how will that trickle down into real estate dynamics and real estate capital values in existing strategies? We've seen that has very strongly affected the UK market, and despite the fact that property values have recovered pretty strongly last year in the UK, we're still pretty well below where we were at peak levels. So the direct implication of that is that a number of financing or a number of loans, debt structures are still in LTV breaches. So that's a situation which, looking forward, we have to be very mindful of that. So the first question is, how do you risk manage your existing exposure and the implications and the potential effects or side effects of banks recoiling, moving back from the debt markets. Historically, bank loans or bank availability of capital has receded after crises, and the averages of 20, 25%, 30% in terms of volumes. That will have an effect on investment markets, specifically, as you mentioned, in secondary assets, secondary assets/markets, but also indirectly into the core markets of Europe. The second theme is, how do you benefit from that? Can you derive a strategy looking forward to eventually benefit from that? And then we have two themes here. Is mezzanine or senior debt something that a real estate investor, a principal, would consider real estate, or is that supposed to be categorized in the debt structure of the market? And here we have a US experience, which is very interesting, which insurance companies in the early 90s actually moved into the realm of the debt market, and actually witnessing a number of interests from US insurance companies to move into the realm of financing in Europe. So that could be a very interesting theme, but the key question is the mismatch, or the potential mismatch, between available capital and the funding gap.
So I'm going to ask Dennis in a minute the main question: is there any money left, or are we just going to go back to where we were 30, 40 years ago with insurance funds providing mortgages for funding real estate? But if anyone's got in the room, just while Dennis thinks about his answer, I'll take any questions after that as we go through. If there's no questions, I've certainly got a few more here. So Dennis, any money left?
From some banks, yes, is the answer. Bank lending, is it the elephant in the room? I think you can probably extend that beyond bank lending and real estate into both real estate and corporates. I think you can extend it also from just bank lending and into the debt capital markets. So include CMBS, include some of the bond structures, include private placement as well. And in the context of that, there are some banks who are better placed than others, for sure. There is a colossal overhang, though, and what we see is a big refinancing spike in the corporate market that comes at us across Europe in 2012, mid-2012. And then if you overlay real estate refinancings that are due, that spikes further, we think, during 2013. So in answer to your question, it is a very big issue that hangs out there, not confined just to bank lending, but the whole financing agenda.
So we've got two big spikes coming up, 2012, 2013. Looks like we're going to have to rely on equity. If there's no questions from the audience, I have to take any questions. Otherwise, I will ask, hopefully, the guys who've got some equity, if they want to come in on at this point. No questions from the room. I don't know which order we'd like to go on. I'll take that first, Emmanuel.
I think the availability of capital, it's a very complex issue. I think what we're coming to is a two-tier market. Two-tier in terms of real estate. It's clear that the prime market is attracting the bank capital for a variety of reasons. The secondary market is not touched yet. And in fact, there's very little evidence of liquidity and pricing. And banks, these days, something hidden within the balance sheet of banks is in relation to this secondary asset. So that's one tier. The second tier is the operator. You have the prime operator and the secondary operator. And why all of that is relevant is that besides real estate lending, as mentioned earlier, you have the development of the capital market like it was in the US and coming back in the US, either to public bonds or private placement. And that will replace a large part of the banking syndication or bilateral relationship which existed. And you see the big operator in Europe, one after the other, having recourse to the public market. Then you have the CMBS, which represent, I think, around 20% before the crisis of the financing needs. And no debt, but in the US we see the first transaction coming back on the CMBS. CMBS was representing 40% of the bank, the total financing capital available. In Europe, you see no transaction, but it's starting. One or two are being prepared, and I would think that in the next 2 years you have a simplified CMBS market, which will be back in the market. Initially with investors from the US. So second source of capital, then the private placement for the non-rated entities, which replace the bank debt. And then you have the funds. Now, among the funds, you have three categories. You have basically fund depending of insurance company or life insurance companies who have a very big player in the US and are going to the Europe as well. And also you have AXA, Allianz, so European entities also looking at that sector. And then you have, in terms of provision of capital, you have the private equity fund looking at mezzanine. Okay, distress, because distress is not there. They're looking at mezzanine. Mezzanine is the key, and it was highlighted, and I think we should further discuss that, because for me, that's the area where nothing has happened in the last 3 years, and everyone thought there was an opportunity, but nothing happened because there were no transaction. But that's a systemic element. You have 500 million of refinancing, average 80-85%. Bank will only do 60-65%. It's purely mathematical. There will be a large tranche of mezzanine available, and there you have the pricing. And then finally, you have the senior debt funds, which are appearing with 7% return. For the mezzanine is 12 plus, which are starting to go on the market, and that's a different type of animal. It's a different type of capital with a different type of requirements. So all together, whether that's enough to cover the shortfall, I don't think so. So what needs on top of it is equity. And further equity investment will be needed to further capitalize the transaction, and I think the money is there. So I think at the end of the day, there will be an imbalance. Price of the debt will rise again. It went down, will rise again, because there's too much refinancing going on. The higher price of debt will attract further third-party capital on the debt sector, and that will rebalance the overall scheme.
So we can rest assured, can we? Maybe Mahdi, you want to pick this up? You're not concerned, even if interest rates rise, there's going to be enough equity. We're not going to see distress coming through.
You were mentioning the availability of data and transparency. I think there is substantial information in the UK market. I think we're lacking information in the rest of continental Europe with respect to the balance sheets of banks and where the quality of the underlying portfolios, and that has to be, I think, addressed. And that's an issue because, lack of transparency, you add a risk premium to that. And if you're an institutional investor, you have a preference today for your domestic market, essentially direct, as that's where the trend has been going over the past 2 years. And of course, for very secure long-term leases, of course, that's the price to perfection. And indeed, as Raymond was mentioning, probably some of those markets, the ones you were mentioning, the ones that have recovered very fast, the London, the Paris, so the core markets in Europe have probably now reached a point where investors will be looking at other opportunities to generate returns and ideally real returns, inflation-linked returns. And if you add on to that the fact that probably cost of capital may increase, you were mentioning increased interest rates. They have already increased since last autumn. We've seen that. The question today is it pricing in inflation? Is it pricing in increased risk aversion or less availability of debt capital? Now, the attractiveness of that availability of capital, which is ready to be invested in the asset class, whether it's going to go direct through funds or to debt products, and within the debt products, as Emmanuel has just mentioned, senior or mezzanine, I think today is still pretty much an unresolved question, because it is linked to where rents will be going, where vacancy. If you take the case of the UK, the bulk of the distress is in secondary markets, and then it's a sort of a self-fulfilling prophecy. And as long as there's no interest for investments in there, you'll have distress will be more acute moving forward. And this is where you may be worried. On the other hand, this creates opportunities on the direct market. So I think investors will try to arbitrage between the two. Will put some of their money into strategies that will benefit from mezzanine. Will seek secured returns, and I don't know if it's 7% is enough to attract investors, that sort of capital. Maybe less, maybe more. And I talk to a lot of investors who are considering, looking, documenting, analyzing, but probably haven't taken the decision yet whether to underweight or overweight those strategies.
Do you think it's now sort of mainstream, the use of both debt instruments, mixing it with strategies on the direct side? Is that now really where everybody should be, or is there a learning curve?
I think there is certainly a learning curve, because these are not the same, within institutions, as I understand it. It's probably not, you have to define which box you would put those products in. Are they real estate? That's the real issue, which is not addressed in, they're not necessarily inflation hedged. Can you structure the product so that it's inflation hedged? In today's market, that's a key question. If it is, then there's an appealing feature to it. If it's not, then it fits into the fixed income box, and that's another question. And you're back into the corporate bond issue or government bond, and then you have to arbitrage within another set of asset classes.
Okay. Well, just any questions before Raymond tells us how we should really be doing it, getting into the value add space? Otherwise, they're all yours.
Well, I think Emmanuel mentioned an important part, which is that you need equity in order to resolve all these problems. Because there is, we've been talking about distress, and we've kind of talking around it, but there is a lot of distress still. The problem is, of course, no one is holding up their hand and say, I am distressed, please help me. But there are many of those situations, and in many cases, those distressed owners do not have the equity or do not want to put up additional equity to resolve the issues. And mezzanine lending, in our view, by itself doesn't solve that problem. Mezzanine lenders are there to take their coupon at a higher rate than the senior lender. But they won't come up with a business plan or a creative solution that will help the bank offload that asset or that loan. Because in many cases, the banks have put themselves into positions in markets, in particular property sectors, that they jumped on the bandwagon at a time that everyone was lending, and now they realize, hey, that market is not for us, or that property type, or maybe the whole real estate industry is not for us. So they have to find a solution to get out of that. And in my opinion, mezzanine lending by itself is not providing that. So we are prepared, and we are putting money to work on the equity side, again in the value-added opportunistic space, but it comes at a price, clearly, because debt, as we have been discussing, is not as abundant as it was before. So we all have to work with lower loan-to-value ratios when we get the financing. That means that if we like to get our value-added and opportunistic returns, which is definitely possible in today's market, we have to start at a lower price. It's always, I mean, that's of course the name of the game in real estate, buying low, selling high, but it probably is even more important today that you enter assets at the right price. What we provide in essence is transitional capital. Right? We are not long-term holders of real estate. We provide capital to assets that need it when the problems of those assets are being resolved, that those assets are being sold to those long-term holders of those assets, and we put our money to work in other situations. So in that regard, we're looking for low entry points, and we're looking for parties that are willing to work towards a solution, at a price.
And just to be clear, I mean, presumably you're looking for IRRs of, I don't know, 20%. What sort of turnaround time are you working on? Are you talking about an entry and an exit in months, or are we still talking about?
No. We're really talking about. I mean, in that regard, I guess what is short and what is long term. When we go into a program, it normally is a 7 to 10 year horizon. Does that mean we can get out in 4 years? There certainly are those situations, and clearly our earlier investments that we were made in 2009, when it wasn't quite clear where the markets were going. We certainly didn't make a lot of investment because the visibility wasn't there. But those that we did make, where we felt there was visibility, we probably will exit those already next year or the year after, and purely because of a rebounding of the market. That's not necessarily our strategy. Our strategy is to solve the problems and to make these assets core, but at the same time we have a very strict return objective, and when that is being achieved, no matter how, the assets are being exited to de-risk whatever the portfolio is that we have at that point.
I was quite shocked there, 7 to 10 years. Now, I will now move this on to Basel 3 and Solvency 2. So if you really want to keep this on another topic, a hand going to go up? Right, okay, so Dennis, Basel 3. Is this a bit of a curveball for you? Clearly, it's been designed, or hopefully now has been redesigned, try and make the markets a little less pro-cyclical and a little more counter-cyclical. Do you think that's going to just work against real estate?
I think it's going to work against bank lending. And in the context that banks lend to real estate, I think it works against real estate as well, right? So I was rather hoping a few hands might go up as well when we got into Basel 3, because it's probably not the best topic just pre-lunch. It could put you off your lunch. The implications, I think, have started to be anticipated by the banks anyhow. So we've known this has been coming for the last couple of years. Some banks started anticipating and moving that way early, but the implications are quite profound in terms of capital allocation and in terms of liquidity requirements moving forward. There's no doubts about that. And that is what is playing a major part in the way in which financing availability and bank lending capacity, particularly to real estate, but to other corporate sectors as well, has shrunk to date and will continue to shrink. I think on the bright side, if there is a silver lining to the cloud, there are some other financial institutions that are, in many respects, encouraged around the Basel debate to start to look at real estate lending. So you look at the insurance companies in particular, and how Solvency 2 impacts them, it would suggest that they're better placed from a capital perspective to look to lend into real estate rather than holding the asset direct. And so that's a potential silver lining. Do I think insurance companies on their own will plug the gap that has been left by some of the traditional real estate lenders? No, I don't. And so consequently, you do need a functioning debt capital market working as well in terms of bonds.
You say traditional lenders. I mean, we should remember that, you know, bank lending to income-producing real estate really has just grown enormously as a function, you know, if not 5 years, 10 years, 15 years. It's not, 50 years, 100 years. So we could actually be going back almost, if you like, to more sort of the traditional finance available for real estate. So it could well be that the last 20 years have actually been unusual.
I think undoubtedly but there's also a point, and Mahdi may well be able to follow this up, or Emmanuel, is that typically in previous recessions, what you've found is that the level of debt that's found its way into real estate sticks. And so where there's been a downturn and real estate has been over-leveraged, it hasn't meant necessarily that debt has been repaid and at a quantum level it's reduced. It's meant that it's taken several years to work its way through and it's effectively plateaued before the market's caught up with it and it takes off again. I do agree with your point. What we've seen in terms of the acceleration of debt into the real estate market over the last 10 years has been abnormal. And consequently, this time, are we facing a different recovery?
I mean, Emmanuel, do you want to come back on any of those points? Is the next few years going to be a very different?
I think banks are commercial animals. I mean, they do a constant arbitration between the different sector of the bank. Shipping finance, corporate finance, any type of activity on the lending side, and other type of activities which are using capital. And I think real estate in the Basel III is not, I think, so badly treated compared to any other corporate or asset-backed type of like shipping. And the reason is because it's mostly secured. No, if we fall within the right parameter in terms of LTV, in terms of country risk, in terms of security, I think we are not too bad off. However, the whole capital and the whole bank will have to shrink its balance sheet. So it's a bank thing, it's less a real estate thing. No. The second thing I would like to say is that the decision about how much capital is available to real estate is not only driven by Basel III, it's also purely, as I mentioned, commercial. I mean, every day or every week, I will look at what my colleagues are doing in terms of return on equity in other activities of the bank, and my boss will say, well, I allocate more money on shipping finance than in real estate because the margin is different. So it's a very commercial decision, and at the end of the day, predicting how much will be allocated by bank in real estate will depend upon the economics of it and the economics of the other activity. So it's a dynamic process. Basel III will indeed have a negative effect on the bank, but I don't think on the real estate in itself.
Okay. Anyone like to pick up on those points, Mahdi?
Just a comment going back to the point I was making about financial institutions. Of course, there is an arbitrage between Basel III and Solvency II, which in some ways resembles what happened in the U.S. in the 1990s. Indeed, if I'm not wrong, total lending in the U.S. extended to real estate tops the $300 billion mark, and those institutions actually generate somewhere between $3 and $6 billion worth of debt per quarter. So there is a precedent in history that actually proves the point that you can have other sources of debt capital coming to the market. You may have banks which, as you just mentioned, strategically decide to go back into this market where they had retreated and not necessarily expanded their loan books in the 2000s, probably because they had been affected in the 90s, and they had probably decided to stay away from part of that market during the booming investment volumes. But that doesn't change the fact that there is still the question of how is that going to be matched. There is potentially, I mean, everyone understands that the economics is there, then it's actually how you make it work. And Raymond gave one strategy, which is the mezzanine way, but I think, as he mentioned, this is not going to be sufficient. There is a need for principal, senior exposure, And then you're back into the question: is that in the real estate pocket? Is that in the real estate quota allocation? And this is where this is where I think institutions are still struggling to decide whether that should be increased, strategically going forward, and for which duration. But I think potentially there is enough capital to fill that gap in theory. But the way it's going to work and actively work and share the benefits of in terms of expected returns, you mentioned 6-7% for senior debt, and then we're looking at 20% and above, maybe for riskier positions in that structure. I think that's really where it's going to happen in the next 2-3 years, in anticipation of the sort of the maturing loan books.
Right, I'm going to move this sort of slightly forward-looking now, although we've picked up a few of these points. But if there's any questions anyone wants to throw at the panel. Okay, not sure where I should start. Actually, I'll start with Emmanuel. We've already touched on a little bit. The direction of the market is going to be a function of required returns from both debt and equity, and there's a lot of regulation involved there. And then, of course, there's expected returns. We are talking about finance, but we shouldn't get away from the fact that we've got to get the income in, we've got to get the rents. So trying to put all those together, what do you think really the path now of yields or capital values is going to be? And you could concentrate on Europe, or you might want to take it more broad.
Well, for a lender, of course, you look at your covenant at the time of the determination of how much you want to lend vis-à-vis a certain asset in terms of LTV, DSCR, and you take a cushion and you take a view as well. I think the key the key lessons, I think, for all real estate lender for the last 3 years, and something we have forgotten a little bit, is that indeed we're financing real estate. And the most resilient portfolio have been the one who have been very real estate driven in their analysis. And it's sometimes irrelevant, the LTV or the amount you advance for the property, if the property will not perform in a downturn and you make a wrong positioning about that. So for most banks now, that's why the prime properties are the one banks want to refinance. Banks realize that they are risk adverse, and we only look at things which they know will be stable in a downturn and have long-term lease. No, the expectation I think we are currently lending on the status quo assumption, in the sense that the new loans which are being done, of course, assume a certain stress scenario in terms of downturn on the underlying real estate, in particular for secondary assets, where leases are still coming to end, and we have to make some discount in that respect. But for prime, we're looking at the status quo. So we create a cushion based on that. But I think the cushion will be well enough to sustain another downturn as the one we have seen.
Well, I mean, I might just bring Dennis back on that one then. So the suggestion seems to be that you're going to price your margins, going to ensure you're going to get an adequate return on your capital. Sort of brings me back to a sort of discussion I've had at previous sessions on, are you actually lending on real estate, or to you, is the real estate loan your asset? It's not the collateral, really. It's the loan that's your asset. It's the borrower that's giving you security.
I think it depends on the view you're taking around your loan book. And so for those banks, typically the commercial and corporate banks, the loans you have on your balance sheet are a take and hold position. You're not looking to trade those loans. Your expectation is if you lend for 5 years, you will be lending for 5 years, and at the end of 5 years, you get your money back. You collect the interest on the way through. If you're an investment bank, then your view around your loan book is that it's a tradable asset. So you are marking the value of that asset on certainly a monthly, probably daily basis. Therefore, you take a different approach when you're looking I think are two things, frankly. One is the transaction, and two is the relationship with the client. And so it depends upon which part of the bank or which bank you're dealing with in terms of the approach there. I agree with Emmanuel's point. Yeah, the thing that has been very, very useful for those of us who are still lending in the real estate market is in many respects less the bounce in valuations that we've seen, particularly in the UK over the last 2 or 3 years. But in terms of lending into real estate now, it's the recalibration of terms where you're back into a sensible loan-to-value ratio. So we go back to 2006, 2007, a lot of finance was being done at 85 and 90% LTV. It was leaving very little buffer, as Emmanuel says, to protect against the downturn. We're now back into the space that 60, 65, 70% LTV is absolutely really the maximum you're nudging on senior debt. So you're back into, when you look at the transaction, it feels like a sensible capital structure. Now, obviously, if we're looking at a capital-constrained world moving forward from a bank financing perspective, from a bank lending perspective, the banks will allocate their balance sheet to the most attractive propositions in front of them. And in a constrained world, that probably means living with the lower leverage that we're seeing today and pricing that is certainly where it is today or maybe north of that.
So a very well-behaved lending industry going forward. No too much lending at too low margins at the wrong point in the cycle. Right, well, we're coming up to sort of the last chance for questions. So any questions in the room before we let perhaps Raymond wants to come on to sort of a bit of future gazing next. Any questions from the floor? In which case, Raymond, I don't know, comfortable thinking about where prices are? I know you're looking for your high IRRs, but what about the fundamental values there?
Well, as we started the discussion, if we call it distressed investment buying assets or loan for a penny to the pound, then that game is obviously gone, and maybe it was never there, or it was there for for a quarter or so in early 2009, late 2008. But it doesn't mean that there aren't plenty of opportunities. And again, we believe currently the real opportunity is for those real estate managers that can find solutions for the problems that are there, but parties not necessarily want to raise their hand and admit to them. And so it will take the banks to make hard decisions, and we're seeing evidence of that, of banks just taking in assets or basically forcing their equity partners to sell the assets with the words, you better sell this or we will do it for you. And no one is interested to go through a long-term foreclosure procedure. So again, that's where solutions that are being brought up by new equity partners with a business plan to maximize those assets, because that's one thing I think we didn't talk about, which I kind of interpreted our session in a way, distressed investment or distressing investments. The longer these problems continue to be there, the more distressed the assets actually become, right? So we've been talking about distressed owners, and most of the assets are actually not that distressed. That's why the extend and pretend has been going on for a number of years, because the banks are willing to close their eyes as long as debt payments are being made. And in many cases they are, because the cash flow is there. It's the valuations that came down. But the longer it takes, and the less an existing owner of a property is motivated to do the right thing, and in many cases they are not in a position to do the right thing because they don't have more capital to do tenant improvements or improvements on the building that are necessary to bring it up to par. And therefore the banks really need to look for new partners, and that's really where we believe the opportunity is. But again, it will come to a price to the banks. I mean, they can't come out completely clean out of a situation like that. So there need to be a discount somewhere. If there is no equity left, it has to come from the bank. And on top of that, as we have been talking about, there needs to be debt capital to finance part of that new venture. And in many cases, we're looking for the existing banks that we're solving the problem for to be part of that.
Yeah, I mean these workout funds, you know, they can only work out assets that eventually are actually going to be worth some more. You know, you can't take every single asset in every single vehicle out there and expect its value to come back.
That's exactly true. So there's plenty, when we talk about secondary assets, and we did that a couple of times during this session, it's a mixture, right? There's secondary and there's secondary, but there are plenty of assets that are being thrown into that secondary basket, because what does it mean? It means basically it's not you know, fully leased. It doesn't have the right credit at the moment. There may need to be done some you know, some physical renovations or improvements to the building. If all these things can you know, can be done, and the assets is, and it comes down to the old you know, real estate thing, location. If it is in the right location, in the right geographic location, if it has the highest use in what it is being used for currently, or should it be replaced from, you know, residential to hotel, or from an office to residential, or whatever it is that provides the highest value in that particular location, then that's what needs to be done. But there is plenty of real estate, as you allude to, Malcolm, that has no existence anymore and is obsolete. And we've seen that through every single cycle. Every single cycle there is plenty of real estate that should just be torn down. And it's destruction of capital, but it's those owners that bought that and those lenders that financed it that will lose the money on those.
Yeah, they should have lost their money, but they have been bailed out. We should keep emphasising that point. Right, I'm going to let Mahdi just have the final comments. So if anyone wants to ask a final question, they've got their opportunity. So just finally, Mahdi, looking forward, distressing or not?
Well, then you may want to ask a question: what's more distressing, to buy today, in today's market, a prime property at 475 and put 50% debt on that, or to buy a long income stream in a secondary market, say at an 8, and probably with very low debt on that? So I think the market will find its market clearing. Again, I go back to my first comment about, I think what is more important from a global point of view is to see if we may have a double dip in the real estate markets without even having a double dip in the economy. We're probably out of a double dip in the economy, but with the amounts, the sheer volumes of refinancing that we're talking about in the next say 5 years, if the markets today are moving away from those so-called secondary markets, we may have a self-fulfilling prophecy. So we're very concerned with the implications on the direct real estate markets, and that actually creates opportunities in the debt spectrum, but also in the direct markets. And I think this is where any investor and strategist should be looking at. You know, what are the opportunities that will be created? And going back to my point about having a stock picking bottom up, if no one is actually looking into secondary markets in the office sector in Southeast England, or shopping centers, medium-sized shopping centers in sort of tier 2 locations in the UK, or CEE office markets or logistics or retail, you could actually have very good opportunities either with a bank or in the direct market. And I think this is where, you know, we're actively looking in different strategies.
Great. Well, thank you for summing that up. I'll be flying back over some of those assets, most of them looking quite shabby, built in building booms of 20 years ago, and a few vacancy boards appearing as well. So I think value destruction for me is going to continue apace for the next few years. But thank you very much, everybody, and if you just thank the panelists in the usual way. Thank you.